There's got to be a way to support the ones who really need it to keep them afloat in the communities.
One of the reasons your data carries the weight is it's seen as neutral.
That's where we get another sticking point, is whether the provider is willing to put that price up to where market actually says it should be.
It's a complicated system, isn't it? I'm only going to say it's a bloody complicated system.
No, you can say whatever you want. Welcome to Time Well Spent, the podcast for decision makers, providers, and everyone working to make a difference in care. I'm Dane Mitchell, joined by my co-host, Rose Plater.
Together, we bring 31 years of combined experience and still counting, and a shared passion for reimagining aged care and community health. From policy and reform to leadership, culture, and connection, this is where we explore new ideas, hear what leaders really think, and uncover what it takes to create environments where time is truly well spent.
The average aged care home loses $3.10 for every occupied bed every day. It's the 10th consecutive year the sector has failed to break even though funding is rising. Care minutes, wages, and compliance have all increased, and yet by 2040, Australia will need at least 400,000 residential care places to meet demand, almost double today's capacity. So here's the question. With billions of dollars in investment required and more than half the sector losing money, who's going to build the beds we need tomorrow? To unpack that, we've invited the man who's closest to the numbers and the one who has the ear of government when it comes to aged care finance, Stuart Hutcheon, Managing Partner at StewartBrown. Stu, welcome to Time Well Spent.
Thanks, good to be here.
So let's start with the reality check. More than half of aged care homes in Australia are losing money. You've said before that for most providers, aged care just isn't investable right now. How close are we to a genuine viability crisis? And what does that mean for the providers who are already stretched to keep the doors open?
I guess for me, we've really been in a crisis for some time. It's just the providers have been pretty resilient with build up solid balance sheets over years, been able to withstand, we've lost $5 billion in the last sort of 5 or 6 years operationally in residential.
As a sector.
Wow. So to me, you can see that the indicators for me about viability issues is there hasn't been investment. So we haven't been building. We're not going to meet the demand for the number of residential aged care beds we need. And we've also got consolidations been happening. There's 736 providers now. In 2022, there was 805. So in a sense, we've lost 70 providers over that 3-year time period. The results are sort of in that we're in a crisis. So it's a bit of how do we get out of that crisis, and are the 1 November changes going to help us out? Because and it's different areas are different, because when we look at those results, loss making, we're talking about homes. So large providers will have good homes that are profitable. They'll have homes that are not profitable. You've got regional remote areas as well. So I think in a sense we're there now. We've got a crisis on demand. Are we going to have the beds? We've got a sort of workforce. So without overstating, I think we're there, and it's a matter of how can we as a sector fix it.
So yourself and Grant and the team are a bit of rock stars in the industry. The StewartBrown survey, I think, is cult status. If we've got one, it's the StewartBrown. Whilst other people from outside the sector may have no idea what I'm talking about. Do you want to explain what the StewartBrown survey is?
Yeah, absolutely. Yeah. So it started, 1995. So we had probably 10.
Don't ask me how old I was at that point, Stu.
I'm not going to ask. I just started as Stuart Brown. So Grant started, we had 10 audit clients who were mostly uniting, aged care organisations who were individual kind of sites, if you like, just started comparing their numbers. Fast forward to today, we've got over 1,200 aged care homes in our survey, which is over 250 providers are in there, and 80,000 home care packages. So the residential aged care is about 46% of all beds across the sector, and home care is close to 30% of all packages. So it's just grown significantly. Yeah, so that's the piece around when it started and how it started.
How do you collect that data? Because that's a pretty big undertaking.
Yeah. So what's been important from the get-go is that we have good, accurate, reliable data, because always people like to say we're different and are you matching apples with apples, and we've worked really hard. So data collection workbook. There's detailed structure around it, and it's granular. So it's granular income and expenditure statement, balance sheet, organisation P&L, but the granular home by home data is what's really important. So submission quarterly basis through an Excel. Some people have technology in place to upload the data into the Excel. We upload it. We've got our own proprietary software that we upload the data into. We've got a new project going at the moment, which is exciting. We're investing for providers to make it easier for them to submit the data and to tie in our data in with their QFR submission as well. So that's a good piece of work that's coming.
Just from my understanding is that would allow them, as they're reporting, they can actually see their performance against the benchmarks.
Absolutely. And the data that we collect now is in a portal. It's in a website. They can go to that website, download their reports, compare themselves to any type of organisation, like similar location, similar size, not-for-profit versus for-profit. Do you have contract catering? Do you cater in? All sorts of granular detail that you can do.
I mean, it's really become
cult status,
or it's probably become the reference point, right, for financial decisions in a lot of the industry. What do you think you've achieved?
Well, I think because, it's been going for so long. And it's always been about the providers. Like, it started with the providers and it still is about the providers. So we've been able to move the data collection, make sure what we're collecting, the methodology we're collecting is in line with what providers want. And it's also in line with the funding level. So, your care funding, your everyday living funding, your accommodation funding. So we've been able to make it work so it can be part of their business, part of their budget, part of their forecast, part of their monthly comparison, part of their strategies. And it's tested by them. Quite often people say, they might say, the numbers are right. Well, it's tested by the providers. Like, if the numbers come back and they're outside the actual provider's results, they'll talk to us and we talk to them. So we would actually, on a quarterly basis, we would go back to anywhere between 100 and 150 providers and discuss their data with them. So people just think, submit a bunch of data, toss it into a spreadsheet, throw it up into the atmosphere and bounce out the numbers. No, there's a huge amount of rigor and data cleansing and checking that goes on to make sure it is accurate. And I think that's a massive difference, why it's reliable.
When I first started in finance in aged care and coming across your survey data and the per resident per day and breaking it down, I was working for a mid-sized firm there and trying to work out how we compare. And you've all got your layers of your quartiles where you sit. You can also see the data by size of organisation. So there's so many different reference points that it's in really good plain language for someone who's new to the sector.
Yes. That
it became a really easy thing to adopt.
Yeah, absolutely. And I think it's a good educational piece too. Like, if people new to the sector come and say new board member, just read this report, read the annual report, and they'll probably have more questions than when they started, but it sort of just maps out how should we understand the finances in residential aged care and home care.
And you release that every quarter?
Yeah, every quarter. And then June's obviously the big one, but we do quarterly reporting on residential aged care and home care, 6 monthly on organisational, and we're doing our corporate administration survey every year. We're now doing retirement living performance survey every year as well.
And you've also jumped into NDIS as well, is that right?
So we kicked off into NDIS. We're running that for a few years. Very difficult sector, very, very difficult sector.
To collect data?
Yeah, to collect data. Obviously operationally as well. I mean, it's in the paper every other week, so it's very difficult. So providers really struggle in the NDIS to break down their data into a granular basis to get it in. Whereas you look at aged care, where it's streaks ahead in the back office, the ability to get good data out to actually know where we stand in this sector, which is helpful for government, IHACPA, those sorts of things. They're going to be making policy or looking at the cost and setting prices and the like as well.
One of the reasons your data carries the weight is, I guess it's seen as neutral. It's not advocacy. It's just the facts.
Yes.
As they've occurred in the last quarter or year. So how do you maintain that independence? And have you changed your method over the last few years?
We talk to the independence piece. Really, we're chartered accountants, You're a CPA down there.
I didn't quite make the chartered accountant rank. Yeah.
No, but a CPA, chartered accountant, we have to be independent with our work that we do. We that's a big piece of what we do. In this sector, in collecting this data, it's so important. We're not the peak body. We're not the government collecting the data. We don't have an agenda. Our agenda is to support the sector, support providers with better overall financial performance, operational performance, strategic performance, all those sorts of things. So it's been really important to us to maintain that independence and to report the facts. We talk about it's nice to have opinions, but generally facts and evidence are more supportable, aren't they, when we're having a conversation, in particular in this sector where we've got profitability issues as well. So,
and you're working directly with the government, right?
They see our reports and we meet with them so that we can walk through and show them the results. They do their own reporting. They get information from the QFR. They get information from the ACFR. We compare that to our data as well, and we have discussions about that. We're going to be down with the government in a couple of weeks, just going through these June results that we've just released. So there's a good dialogue with them. That's with the department. Good dialogue with the Quality and Safety Commissioner, the Inspector General's office, IHACPA, as well as the government of the day. So we do talk with the government who's in and also the opposition as well. So there's a good dialogue where we send out all of our reports and discussion papers so they get the opportunity to read it, question it, which we hope always happy to get feedback and to be challenged on our numbers as well. So, and probably to your point about the methodology, we've made sure that we keep it up to date and change the methodology or the data collection or the focus in line with changes to government policy or changes to the funding model or what's happening at the day. So, I mean, an easy one, obviously we moved from ACFI to ANAC, so we want to get that right. There's a big focus on minutes, so you've got to have the right sort of data collection around that. COVID, that was new line items. Let's talk about COVID funding, extra costs in COVID and the like. So
often providers will ask me, looking at, designing their new facilities, what's the right number of beds do I build? What makes me the most viable?
Yes.
Do you have thoughts in that space?
Yeah, absolutely. Yeah. And with our data, you can slice and dice it the way you want and look at, 40 beds and under, 40 to 60, 60 to 80, 80 to 100, 100 plus, if you like. So it would have been 4 or 5 years ago, you were looking at those smaller homes because lots of homes built back in the day were smaller, weren't they? But these days, 40 beds and under, there's basically no way of sort of getting a return, So it's around that 80 to 100. And that's been increasing sort of year on year, that 80 and 100 beds. So you kind of think, well, what would I build? What size is going to get me the best return if I've got a greenfield site or a brownfield site? But, we'd be suggesting today it might be around that 80 bed mark of residential, but you'd also be wanted to put some retirement living on that site or some assisted living on that site as well. So that's got a big part to play, that connection between retirement living, residential aged care and home care.
The average aged care home is losing $3.10 per bed per day. And this is the 10th year the sector's been in the red. Can you break down where that loss is or where you see that loss coming from?
The sector has been losing money year on year, and it's really only had a
I don't think the general public would understand.
No, they wouldn't. No,
they just see the negative media perception of aged care. They don't understand the pressure providers.
They see $40 billion in RAD money. It must be floating in cash type discussions. So, we've been losing money year on year, and there's only been improvement in recent years around the ANAC funding and providers getting their ANAC funding before they had to meet their minutes. So there was a bit of a margin built into that. So where do we make money and where do we lose money at the moment in residential aged care? We're losing money overall. The margin at the moment is in direct care. So how, it's about a $16 per bed day margin at the moment that we're getting. And that will...
So direct care is like your clinical care, your
So you're
care.
Basically your ANAC taxpayer funded government funding, paying for the costs of care management, RNs, ENs, other nursing, allied health, and other sort of chemist and medical. So that care area. So that, that is propping up the result, which is a loss anyway. So that's, around about, on average across Australia, $16 margin. Everyday living, so that's where you've got your daily fee, which 85% of the pension plus your hoteling supplement, that's $15, is going to go up to $20. Everyday living's losing about $7 a day at the moment. And then accommodation, which is your accommodation revenue versus your accommodation costs in your P&L, and that's losing $12 a day. That's the numbers and the metrics. So how do we fix that? Because what we do know is that the margin in direct care is going to reduce because 35% of providers aren't meeting their minutes at the moment. We're going to have audit around our minutes. But if you're in overall, all minutes we audited, but MMM1, there could be a reduction in your subsidy with a new supplement in the new year. So we would see that the margin in direct care is going to come down as we meet minutes. The new hoteling supplement that's just been announced from 1 November as well, the $22, that hopefully will get everyday living to break even. So that's like, that's exciting. We're going to break even.
Yay.
But that's a good thing. We've been losing money for so many years. We're going to break even, but there's no, again, breaking even. So accommodation is the answer for us at the moment, is going to be the result around that positivity around now being able to have higher accommodation price before you need approval, the $750, which has been in since January, but the retention, the 2% retention. But of course, those changes that are coming through and the extra co-contribution in everyday living, it's going to be years before we see that fully roll through the system. So we're nowhere near out of the woods on financial performance, I would suggest, in residential aged care.
And at a time where we need people talking to people like Rose about building new homes. I think your data was that we almost need to double our capacity in the next 15 years.
Yeah, absolutely. And that's the demographic data coming out of the department's annual reports. The simple one for me is, we need 40,000 more beds in 5 years. So if we get about in 10, 15 years where, hopefully we might be retired laying on a beach somewhere, but 5 years' time, we need 40,000 beds. Yeah. We're not going to build them. Where are people going to get their care?
Victoria, I think you mentioned recently, hasn't had anywhere near beds coming online. I think there's perhaps, a handful of actual active beds in the last 5 years.
Yeah, the last few years, overall across the country, is about 5,000 to 6,000 new beds. So where are people going to live? You're at 94.4% occupancy now. You talk to providers, they're at some providers 96, 97, 98. At 95, 96, you're basically saying you're full.
Because you have turnover.
Yeah, so you turnover. So where are people going to get their care? And especially where are people going to get their care if they're low means?
Yeah.
And it would take, this might be a question for you, Rose, but, if we need 40,000 beds in 5 years.
Yeah, 40,000.
I mean, it's not a
you can't
1 or
build.
2 year process.
You can't build in a day.
From design to opening, it'd be 4 or 5 years.
Oh, absolutely. Once you put in DAs and all the planning and design and, understanding what you want to operate, because there's operating an efficient 80 beds or there's
a bit of urgency to come and talk to Rose.
Yeah, that's exactly right. But there's got to be the appetite and the incentive to do it, and board strategy with their executive management teams, their C-suite, the absolute business case to go and do it.
Yeah, absolutely. And it's hard when on average we're sitting at a margin of -2 to 3%, I think.
Yeah, like there's no margin at the moment. We need to get on a 500,000 per bed build. We want to be getting a 4% return, which would be, heading towards that $20,000 EBITDA per bed per annum. At the moment, the EBITDA is around that $6,000 to $7,000 per bed per annum. So there's a way to go to get there.
And even at 4% return, you're still relying on a lot of the sector being not-for-profit, right? Because you can probably get a much better than 4% return doing a lot of other things.
That's exactly right. Look, there's a lot of the for-profit providers are investing in building, and you can look at them and look at their annual reports, and they know that there's the demand there, so they'll be in it. But there is a heavy reliance on not-for-profits, in particular when you start to get out to regional and remote.
One of the things is the significant refurbishment supplement. So my understanding is that's continuing as it is.
Yes.
And so that supplement is backdated to 2012 if you've spent $25,000 or more on the facility per bed. Since 2012. That is now a very dated refurbishment. Yes. Is there any discussion with the government around those incentives to help build, particularly in regional areas and particularly for concessional?
Yeah, so that accommodation supplement is under review at the moment as part of the accommodation pricing review, and I think there's submissions due by the end of this month, so get in if you're going to do it this week. But that is absolutely on the table to review that accommodation supplement for supported or concessional residents. And for us, that would be a huge game changer to get that price dollars per bed day higher, let's say by another $40. And even if you talk to providers large and small, if they could see that increasing, they'll absolutely continue to invest and probably increase their overall investment. We see that as one of the last big pieces of the pie to try and get that uplifted, and the review is on at the moment.
Is there many facilities that you see in your reports or in your survey that haven't got that supplement activated?
Most organisations, like 46% of the sector at the moment, there's 46% are supported residents in residential aged care in our numbers. So there's definitely utilising that as it comes through, but there's got to be the overall incentive, doesn't there? The overall return on investment has to be there to build, whether you're building for supported residents or non-supported residents. And of course, the boomers are coming.
Look, well, I mean, what you're saying is it's kind of the opposite of a profit story, right? It's sustained losses. And if you talk to a punter on the street, they potentially have the perception that, it's all about the money and, it's all about making money. It's not about delivering care. The reality is it's just not true. But why do you think that perception persists? Because I think that's a big part of the problem. And one of our reasons for doing this is I think aged care needs to be better as an industry, telling our own story.
Yes.
And having uncomfortable conversations.
Couldn't agree more. The bad media, that the lack of understanding of how the sector works from a pure, if I just talk financial piece point of view, is harm to the sector. So being able to get a better understanding, if you like, of the sector out to the community. And when I say the community, that's, if you go and your friends would call you up, you work in the sector, I need to get mum or dad or grandma or grandpa into care. How does it work? Like, it's complicated and they don't understand. But I don't think the media hasn't done us, much justice in recent years, year on year. We've worked closely with a number of journalists to try and change that view. But there's also a lack of understanding, I would say, from politicians, from, government of the day as well, about how it works. Even if you just take RADs. People say, oh, there's $42 billion worth of RAD money out there. You've got all this cash to do what you want with. Well, no, you don't. It's a liability, isn't it? Yes, you can get it. You build, you repay it back some debt, but you're not, and you can invest it and do those sorts of things, but you're actually handing that money back. So it's not there. So I think it's just lack of understanding generally. So I think if we were to do one thing, things like this and other things, is to try and educate the community what the true costs of moving into aged care are, and that you need to pay for it if you can afford to pay for it. Those people who need a safety net, who low means, should exist, and we need to have that going forward. But if people have the money to co-contribute to their care, to maintain the lifestyle they're used to, then we're going to need to do that. The family home's a classic one, isn't it? Waiting for mum and dad's inheritance. What do we do with that discussion? Because we talk about mum or dad moving house. If they're moving to retirement living or they're moving into residential aged care, they're moving home one more time, aren't they? So we have to pay for that somehow. So we don't want to sell a family home. We need to have a way to pay for that as well. So there's been some, I guess, really bad media in the past when, those listings occurred, and there's some, sort of photographs around about, Lamborghinis or whatever. That's just not what the sector's really all about. If you look around the sector, you've got good, well-meaning people and organisations who are doing the right thing by people, but the funds aren't there. So, read our reports. You go and get the last 10 years worth of reports and read them, and you can, it's all there in black and white for people.
It's all public.
I really worry for the regional independents. I'm a volunteer board member myself for a regional, smaller, independent, sub 60 beds. We're few and far between now as an independent, but that we risk closing down the town as well.
Yes.
If we don't sustain that. If we merge with others, we may be the non-performing site that closes down, and therefore the ripple effect of the 75 years for Clifton Health Service in the space just disappearing. And what does that mean for Clifton? So really passionate about keeping the story and the conversation going.
And that's been such a story of aged care in Australia, right? Is that it's been community members contributing time, money, skills, sweat.
Absolutely. Yep. Donation of land.
Yeah. all the chook raffles, all of the,
100%. And I'm a board member as well, Stu, but there's some awesome organizations that are taking these on, doing a good job of keeping their identity, but I don't think we should have a sector that can't sustain
one size fits all.
Yeah, no one wants the Coles and Woolies, if you like, of aged care. And to your point about the regional remote areas as well, they're often always the largest employer in town. So
absolutely.
then what actually happens to the town? So maintaining those homes and keeping them afloat is really important. It's just about what is the mechanism to make that happen? Is it capital grants, to help with put more beds on to make it viable and sustainable? Is there additional types of funding? We've talked about those smaller homes like yourself, like you just get, if you're 40 beds, you get funded for 40 beds. Whether you got 38 people, 35 people in the beds, you just get funded for 40 is a way to kind of work on that. But
do you think there's an appetite for that sort of reform from the government? There
is additional, funding, in particular classifications at the moment. So I think they're aware of it. And I believe that the government doesn't want any of those homes to close. It's about how you can make it viable. And it's hard, isn't it? When you are single and you are standalone, is how do you maintain your product, like the physical asset, but also you've got all those back office admin corporate costs that you don't necessarily aren't able to split across a number of homes. So economies of scale in the back office, how do we work that out better? Is there ways to partner and you outsource or get together with other community groups that can share the regulatory burden as well?
One of the things you spoke about recently too, though, is that not necessarily getting bigger saves you on your admin. Your survey suggests that there is a sweet spot at probably less homes than people once thought.
That's right. Yeah, you could see when you do look at homes, say 5 homes or 1 to 2 homes, 5 homes less, 5 to 10, 10 to 20, there is a sweet spot there. And I think that comes down to the organisation as well. This doesn't necessarily saying, having over 20 homes is bad or having 10 to 20, because if you're up between 10 and 20 homes, is it best at 15? Is it best at 18? But it's about how you run your business and how you run the back office and the location of those homes. If you're New South Wales based, but you happen to have 1 or 2 homes in Queensland as well, is that in your best interest to try and run a couple of homes in Queensland, or should you just focus in New South Wales? Or national providers will be thinking about that type of thing all the time. But it's got to be viable, sustainable, investable, dare I say, to be running those homes, or there's got to be a way to support the ones who really need it to keep them afloat in the communities.
Your data shows that administration and compliance costs have jumped to more than $53 per bed per day. And that's up nearly 15% in just the last 2 years. What does that mean for providers, both the big ones, but also the smaller operators like what Rose and I are involved with?
Yeah. So trying to fund that has been the struggle for a long, long time. So when you think about,
we've got increasing compliance
that's
every year, right?
That's right. You're not necessarily getting, more funding to support that additional cost structure. So if you think about larger providers, they're looking at this all the time. You may have seen, we just released our corporate administration survey, and you look at that, and the highest costs that are of no surprise that are increasing is technology. So we will talk about, let's get new technology, or let's improve our technology to get efficiencies, maybe have some innovation, dare I say, to actually do the back office things, but to support the provision of care services. So tech's up there, finance, payroll, HR, then the next categories that keep increasing. So I'd say the bigger providers are focused on it all the time and trying to look and see where they're at, and it's a discussion all the time, but they do have scale to spread across, don't they? Smaller providers need to be thinking about what they can do to minimize that cost structure, and can they outsource particular areas of their finance or admin functions, or could they group together? Like Pace Aged Care has been around for a while in New South Wales. There are other models where community-based not-for-profits have come together to try and share some of that back office, get some purchasing power, those types of things. So they're the things we need to be thinking about, but it's not easy. None of that's easy at all, and attracting good people at a low cost as well is quite hard.
On our first episode, Nick Ryan from Lutheran Services asked Nick if if it was sustainable for community providers, community-owned, local not-for-profits to exist. And it wasn't a goal of his, but he said, look, I think that under the current rules and funding, it's going to be tough to continue.
Yeah, absolutely. It will. And we're seeing the consolidation, aren't we? And you see, organisations like Respect Aged Care who's consolidating,
Wouldn't do a lot of great work with regional providers.
Yeah, Apollo
Baptist Care.
Yeah, and certainly the larger faith-based organisations have been doing that and taking them on. And as I said earlier, in 3 years, we've seen 70 providers. We'll see further consolidation because the funding model's not there. And it's a business too, isn't it? It's a business we're operating. And I find it's not a general rule for everyone, but you find that unfortunately in some of the areas, the product that was built 30 and 40 years ago isn't going to be fit for purpose. It may not even be fit for purpose now, and they don't necessarily have the balance sheet. They've been we've been loss making, so they've not been able to put cash flow aside to rebuild, refurb, do those sorts of things. So those financial metrics you're up against it as well in those particular areas. So it would be sad not to be able to maintain those years and years of history that people, the local communities all put into those homes, but the model makes it difficult, more and more difficult.
But it's better than the alternative of the service not being available.
That's exactly right.
And I think there is an opportunity too for community providers, I think particularly in that not-for-profit space, have been reluctant to charge for what they're probably doing as additions. I remember, there's a lot of goodwill, and what was once done via volunteer, we're not seeing the volunteers in the space, but there's a reluctance. So I think we need to see more confidence from independent providers to charge for the services they're providing to those who can afford.
That's right.
In line with the legislation. So there's not using, I guess, the opportunities that we have to create that.
Where you can, where the need is, and that you quite often hear about, sort of some of the people entering care then they might be asset rich and cash poor. So how do we access those assets to pay for their care?
Do you think the government and the agencies setting the prices, do you think they understand the extent of the problem?
Look, I think ultimately it's a complicated system, isn't it? I was only going to say it's a bloody complicated system.
No, you can say whatever you want.
But it is complicated.
Yeah.
So, you try and explain, moving mum or dad into residential aged care to any of your friends or what it's, and if you have to do it personally, we work in it every day, but you take a step back and have a look at it. It's a complicated system. So I think that the parts of the various government departments, I don't think they quite grasp what's actually happening. So it's how we all work with them to improve them, educate them.
Tell the story better.
That's right. Yeah, absolutely. Tell the story and keep giving them evidence.
Yeah, I had a conversation with somebody in the pricing authority in terms of the impact of the built environment on the actual direct care minutes. So obviously a personal carer in their day going through, let's do the shower rounds.
Yes.
Looking at the lost time and how we're trying to put a one-size-fits-all minutes approach. However, your built environment drastically affects what actual time is with the resident. And I guess their lack of consideration in that space for maybe I've got a really efficient facility, and whilst I might not meet the minutes per day, I'm actually exceeding the one down the road that is because of the way I'm operating. And I think the small household model is a great example of that efficiency with such a great outcome to our resident, but the funding mechanisms haven't caught up to kind of capture the real value there.
Yeah, and I think mentioning the built environment's a really important one because you might say, what do the best performers do financially? How do they get there? Well, sometimes it comes down to it's not even possible because the building hasn't been built to be efficient.
You've got a 1917s build.
Yeah. And even, there's even buildings that were probably built 15 years ago, 20 years ago that were focused on, we go back to the old language of low care, hostel, that type of thing, not focused on high care, end of life care, dementia style care, where to physically for the care staff to get around and deliver the services that they're delivering, they need a good set of runners to sort of get within that time period to get the work done. So that's a real challenge. Yeah.
Yeah, the old donut design in the ACFI system where it was more about just routine supervision. I need just to walk around and do my rounds rather than actually see and be with residents. I think there's a lot of lost time, and you'll be probably surprised that some of the older buildings are far more efficient than some of what's been built in the last 20 years because of the ACFI model and kind of where that pushed providers.
It's pretty hard though, isn't it? Like you sit there and you think to yourself, okay, I'm on a board and I've got an executive team and we're about to build, something, and we might now spend $500,000 per bed. Where's the crystal ball? How long will this thing last? What's going to be important to people?
And you're talking about 10, 20, 30, $40 million
yeah, absolutely.
decisions, right? That are hopefully going to return for 20, 30 years.
That's right. Yeah.
You've forecast by 2026, the sector could finally move back into positive territory, about $1.70 per bed per day. Where's that? Obviously, we've touched on some of the less positive things. But
and the next 12 months as new residents move in, because this is the thing we've got to remember, all the positive things that are in the Act around finance and funding have to flow through with new residents, and I heard on one of your other podcasts a discussion about death in aged care, but that's what we're talking about, is departure or death of a resident. So in a sense, that needs to happen with new RAD payers coming in. There's going to be a retention, the hotelling supplement, the co-contribution, all those sorts of things coming in. So well, the real benefits are really we're talking about in 28, 29 and 30, sort of 3 years away for the system to roll through, that we're going to see the real financial benefits. And again, that's going to has to be in the accommodation area. Just has to be. It's clear from, we released a discussion paper recently around the new ANAC price and the new hotelling supplement. And we spoke with IHACPA, and we've got quotes in there from IHACPA, but it's not built into their mandate to be a margin in direct care service delivery. And everyday living through the hotelling supplement is going to break even. So it's got to be accommodation.
One of the things that Grant talked about at your dinner that we attended at the national conference, thanks for that, it was good. Yeah. Good Italian. Was that the government's been trying to work out to fund costs, not margin.
That's right.
That's a deliberate decision.
Yes.
For a reason, but that's going to have to change.
Yeah, and I think, look, if you think about the Royal Commission, and it was in there as well, like taxpayer funded subsidy is to deliver care and services, direct care. And then it's about how you can make everyday living work with additional services or health, and how you can get your accommodation price at the highest possible level in your particular home, in your particular area, how you can take advantage of the retention. Hopefully we get an uplift in that accommodation supplement as well, but make sure we understand, we're talking about the rent model now. What does it cost you per day for accommodation? Do you understand that when you're going into a build to get that, return, that 4% return on your investments is really, really important, how we get there. But then that return needs to be there. Otherwise there won't be any further investment, will there?
I think that's a powerful call out because we've always talked about the room price, but as people are coming in shorter, we're seeing less RADs and more DAPs, and really reversing it to be, well, what should the rental be, which is your DAP, and then what's the equivalent room price of that?
And just maybe explain what a DAP is for anyone that may not be sure.
The daily accommodation payment, which is built around the interest at entry day on your room price.
So instead of paying the $500,000 or $700,000 RAD, you can pay
a version of interest on that.
A daily amount. Yeah. And importantly with that, it's that discussion and understanding of that. But at the moment, about 37% are RAD payers, 41% are DAP payers, 22% are combinations. We would like to see more combinations. So, if you have people, you've got a higher RAD price, people mightn't be able to meet that RAD price, that they pay a portion of the RAD price and then pay the rest as a DAP, or draw down on the RAD amount that they're paying. So that combinations we would have thought we might see more of going into the future, because the providers need to get this return to be able to, deliver in the future and build and invest.
And the DAP's a reasonable return compared to what they might get in the market.
But even with the DAP, as long as that DAP amount is actually what is going to cover the cost to deliver those services and to repay the price of building the accommodation.
But it's set as a percentage of your RAD.
That's right.
Yeah,
Yes.
gotcha.
Yeah. So getting that right and understanding that on your existing products and builds and on your new builds is paramount.
You've said it costs upwards of $500,000 a bed to build a new aged care
I might debate that. But
facility. You can do better.
Do you think it's more?
You need to talk to another builder.
Yeah.
I think it's less.
What's your number again? But from an investing point of view, you're talking about trying to get to a 4% return. We're at a negative return. You can do better putting your money in the bank.
That's it.
So what conditions would give investors, whether not-for-profit boards or private capital, the confidence to build to meet the doubling of the sector we need in the next 15 years? Or the 40,000 new beds in 5?
The easy sort of standouts for me is the demand's there. So you've got the absolute demand is outweighing supply. So there's some confidence built into that. We've got occupancy is high at the moment. There are changes to the funding model that is going to allow you, as that flows through to new residents coming through, that there will be the funding there to build, and we should get the result. Broken record, but if we can get the accommodation price right and we can get accommodation supplement right, that the funds will be there. So you're putting that based on the current numbers, the current government policy, the current funding model, that we will get that right to then obviously invest. But I would have thought there's optimism and positivity around the sector that will happen. We're still a couple of years of working towards that. But at the moment, people are starting to look into, Rose, I don't know what you're seeing, but they're looking to build, they're
absolutely.
looking to invest.
Yeah. And I think it's nice to see the clients who have built just how quickly a good product sells.
Yes.
People, particularly in metro and in regional areas, when they see that there's quality there and they can see there's a difference between, what mum's room built in 1982 looks like versus this alternate, you find an acceptance far more readily, I think, to do that. The provider obviously has to be willing, and I think that's where we get another sticking point, is whether the provider is willing to put that price up to where market actually says it should be.
I think we haven't talked about it much today, though, that I think it's also what are they going to build? So there's a huge sort of more interest at the moment in building retirement living or assisted living or independent living units, seniors
that's
housing.
Because you can make a return, right?
You're getting a return. So that's, and we did some work looking at those new liquidity policies that are coming out. We did some work early in this year, and we covered off a significant part of the sector, and we asked lots of different questions about their RADs in and out and their cash flow. But we also asked about what they're looking to build in the next 5 years or so. And when you looked at the larger providers, on average, there was an investment, say, in total of 700 million, if you like, in building pipeline, but probably only around 200 million of that was in residential aged care. So it's about retirement living as well as being a big part of the sector, how we deliver support at home or home care into that retirement living unit as well. The only call out I would say is to get everyone sort of thinking, if you like, is in residential aged care at the moment, there's supported resident ratios, isn't there, for people with low means? That's not regulated in retirement living. Yeah. So in retirement living, you want to make your money through that ingoing contribution, get your deferred management fee or retention or a membership fee, whatever you might be calling it.
But we have to get the mix right for the
how are we going to support the community?
The care.
Yeah, absolutely.
And so obviously the change to the retention is a good step towards, but we've got probably a consumer that doesn't necessarily know what is the difference between retirement villages and residential aged care. Sometimes it can look and feel in terms of integrated care very similar, but if you're under the Retirement Village Act, you as a provider are probably getting a 30% clip of the ticket.
Yes, absolutely.
And then under RAC, the maximum is 10 over 5 years.
Yeah, that's right. Yeah, 2% a year. Yeah.
Would you expect that to change in time?
we would like to see that 2% increase in time. Yeah, I think the task force report was talking about 3% originally, and it came in at 2%. So we'd like to see at least getting back towards that 3% in residential aged care retention for sure.
And it's extended beyond 5 years, or
average length of stay in a residential aged care home is generally less than that.
5.
So I think it's more about the percentage
than it is about the tenure.
That's it.
And one of the difficulties too, I think, in residential in that space, and this is probably getting a little bit nerdy, but is that it's on the date of entry. So you have people, and particularly in regional providers, who have been there for a long time, who might be paying, an equivalent of 2% DAP on a $200,000 room price. And so we've got a locked in, not that we don't want to provide care, but there is no, I guess, opportunity to improve that accommodation income for a lot of people in the sector, particularly in regional areas.
And then it's about, those regional areas as well. Well, can we charge a higher amount, but then we draw down a DAP from it as well to try and make that work?
Yeah. If you were sitting in the room with Treasury or the banks, what would you tell them needs to change?
Yeah, good question. Look, well, if you think about the banks, they need to be confident that they're going to have their debt repaid on a borrow for a build. So absolute confidence for the bank that there is revenue streams that are coming through that accommodation that's going to repay debt. That absolutely, and them understanding that and that model, because the removal of the ACAR, the allocation of the bed license, that's gone. They used to like that because that's a locked in place. But no one else can build beds because it's locked away. So they need confidence that's going to happen, and I'm sure that's on their mind. Treasury understanding the whole model. Look, when we talk about the department, when we talk about the government of the day, it does actually come back to Treasury about what funds we have available to government to pour into the aged care sector versus education versus NDIS versus hospitals, roads. It just goes on.
Yeah.
And that's what the task force was all about, looking at that co-contribution for those residents who are coming into care in the future, and talking about the boomers. If they can afford to pay, they've got to pay for their care, well, not their care, taxpayer funding will look after their care, but pay for their everyday living and pay for their accommodation at an appropriate rate so that providers can get a return that they should be getting so that they can continue to invest. So Treasury understanding the cost to deliver care is really important about the taxpayer funded subsidy. The overall cost of everyday living for that hotelling supplement is really, and they're getting informed by HACRA, and HACRA are doing a good job. They're doing data collection, they're looking at the data, they're challenging it. But the accommodation, to be honest, is now coming down to the providers to make the good decisions about their accommodation, type accommodation, price of the accommodation, those types of decision making, their mix of RADs versus DAPs versus combinations. It is in their hands to really look at that and understand it at a home-by-home basis.
Sounds like there's two real levers that you're advocating to be pulled, which is the reality is with the demand coming, we're going to have to contribute, those with the means to.
Yes.
We're going to have to contribute more to our care, and that's probably going to be in the form of higher RADs.
Yes.
And on the other hand is as taxpayers and citizens is we're probably going to have to accept that a higher spend of government money is going to have to go into aged care, because if we don't, providers can't make a return, or therefore the investments to meet the demand.
And the reality is that we end up paying for it anyway, because those who end up in the hospital system are where the beds should be.
And it costs significantly more in hospital, right? Is that?
Yeah,
absolutely. Yeah, significantly more.
I think so. Having state treasury at the conversation table a little bit more
they
about.
They might have a different opinion.
We can save a lot of money by funding more aged care.
Yeah, all those moving parts, the whole health system has to come into it. Absolutely.
You've been analysing this data for nearly my whole life, many years, Stu.
Oh, young Dane. Any opportunity.
What's the one indicator you look at that tells you whether the sector's healthy or in trouble?
Dane, I'd say the Stuart Brown survey.
It's a wrap.
Yeah, that's it. Absolutely. The overall, one indicator is that operating result, which flows into your EBITDA result.
Yep.
those two indicators on the table, an aged care home, whether it's making money or not making money, or will it make money in the future, is absolutely the indicator of financial performance to drive care service delivery and the future of care. You can go and pull out balance sheets and things and look at, borrowing to build and all those sorts of things, but that overall
you need
financial
to be able to
performance,
make money from operating in aged.
Yeah, we're talking about a sector that's had operating losses, 50% of homes losing money year on year for years. We had an improvement in the last couple of years because of the ANAC pricing and the minutes, we know that, but we are at that 55% losing, 30% is cash outflows. So that doesn't work for anyone. Cash outflow doesn't work in your personal bank account. It doesn't work in business at all. So those indicators are going to be the continued indicator of the sector. And you could go and look at the number of providers, you look at consolidation, you look at the lack of investment and build. Those financial performance indicators are the big tickets.
And so much, I don't think the general punter would understand how much of certainly the not-for-profit sector is funded by the returns they're making in their retirement living businesses, offsetting the losses in residential care. But a lot of those retirement living assets are old and depreciating. That's
right. Yeah. We've got a retirement living survey as well, and the average age of an RV in our survey is about 30 years old as well. So again, you get in that same discussion.
There's going to be a point where they can stop funding the residential operations.
And what is the next resident coming into care, into RV looking for? Overall, not just at a residential aged care level, but if you're an organisation that does resi, retirement living and home care, an overall strategic picture of that business and what it will look like in the future and how do we support that business going forward is really, really important.
So you talk a lot about accommodation, so I'm hoping this one comes in answers to. If you wake up tomorrow and it's your turn to be a client in the aged care sector, what accommodation would you be looking for?
He'll need somewhere for his boat.
Might be boating by then. I should be keen on it though. Look, obviously people want to.
No, not people. You.
What do I want?
Stu, this is all getting personal.
We might get personal here. Like, what do I do on Saturday afternoons?
Need 2 beers.
Yeah, that's it. Yeah. So you want to be able to continue the life and the things you've enjoyed. So I want to be comfortable in where I live, but I want to have those support and services that are going to be looking after me, whatever I might be needing, but access to your family and, the people and the environment you're in, so you can still, remember the good times. So, it might be a bit of sport on the telly. There might be a beer close by or something like that.
Hopefully the young fellas watching the young fella play basketball.
Yeah, absolutely. So, but
I'll be the grandkids.
Yeah, the wakeboarding days might be over, but having your family around is really important and being sort of, cared for and access for them as well. You'd have to worry about like the number of beds and,
you want to be in a small facility
availability for where you might be, where your family lives. Am I going to have access to that? If you're, even in the city, whether you're in the city or regional or even remote, will there be a bed available for me? Probably on my mind, in the future with this demand that's going on at the moment. But I think everyone...
Can you stay close to your family?
Yeah, absolutely. That's what
I had an interesting conversation with a mate of mine. He lives at Malangani, out the hour west of Casino up the range, and they used to have a 15-bed rack at Bonabo, and his dad, he lived there and passed away there, and it's so important to those guys that great community, great people, soul of the earth, the kind of people that build Australia over generations.
Yes.
But they want to stay close to their community too, and that's really what everyone wants, right?
Yes, that's right.
You may be older, but you still love your family.
Yep.
You still want to see the people that matter most to you.
Yeah, and you still want to be able to have those. Your body might be giving in, let's just say, but hopefully your brain's still functioning well. But you want to be able to have those conversations and reminisce about good old times and the like as well, and see the new generation coming through. So,
Stu, that's the end of part 1. You'll have to tune in next week where we talk about what providers can do to make a difference.
Sounds good.
I hope it was time well spent.
Thank you. It was.
Thanks for listening to this episode.
If this was time well spent for you, follow the podcast so you never miss an episode.
If you want to support us, leave a review and share it with someone in your network who might get value from it.
Finally, a thanks to our partners who make this possible. Painters, your design and construction partner.
And Optum Allied Health, your physiotherapy and allied health partner. You can find the links in the show notes.
Thank you for listening. We'll see you on the next episode.